Long-term investing is the most evidence-backed strategy in finance, yet it demands behavior that feels deeply unnatural. The market rewards patience, but our instincts push us to react. Unpacks the data behind the performance gap and why our brains are wired to lose money. For 3 decades, Dalbar has tracked the actual returns investors earn versus the market itself. The results are stark. The S&P 500 delivered an annualized return of 9.65%. The average equity investor earned just 6.81%. That's a gap of 2.84 percentage points every single year. Over 30 years, that difference compounds into a staggering shortfall. The market is not the problem, our behavior is. Let's formalize the problem. The performance gap is simply the difference between what the market gives you and what you actually keep. It equals the market return minus your realized return. That gap is driven entirely by behavior, buying high, selling low, and trading too often. If you could eliminate that gap, you'd capture the full market return. This bar chart visualizes the Dalbar data. The left bar shows the S&P 500's annualized return of 9.65%. The right bar shows the average investor's return of 6.81%. The difference, 2.84 percentage points, is the cost of behavioral mistakes. It's not the market that's inefficient, it's our decision-making. The gap comes from a handful of well-documented biases. Chasing performance means buying after prices have already risen. Panic selling means dumping assets after they've fallen. Overtrading racks up costs and taxes. And loss aversion makes us feel the pain of losses twice as intensely as the pleasure of gains. Together, these biases turn a winning game into a losing one. Research by Barber and O'Dean reveals a striking pattern. Male investors trade 45% more often than female investors, and that extra trading costs them 1.4 percentage points in annual returns. Single men trade 67% more than married men, with even worse results. The lesson: overconfidence leads to overtrading, and overtrading destroys wealth. Here's the counterintuitive twist: the difficulty of long-term investing increases with education and income. Smarter investors often fall into the trap of overconfidence. They believe they can time the market or pick winning stocks. But the evidence shows that more trading leads to lower returns. The smartest move is often to do nothing. Let's quantify the cost of overtrading. The annual cost of overtrading equals the excess turnover rate times the cost per trade. Excess turnover is how much more you trade than a buy-and-hold investor. Costs include commissions, bid-ask spreads, and taxes. Even small costs, compounded over decades, can erase a significant portion of your returns. These are the numbers that should anchor your investment approach. The S&P 500 returned 9.65% annually. The average investor earned only 6.81%. The gap is 2.84%. And overtrading costs men 1.4% per year. Keep these in mind when you feel the urge to trade. The antidote to behavioral bias is a portfolio so boring that you forget about it. That means low-cost index funds, a fixed asset allocation, and automatic rebalancing. When the market drops, you don't panic because you have a plan. When it soars, you don't chase because you're already invested. Boring is beautiful. Why does the gap matter so much? Because of compounding. The future value of an investment equals the principal times 1 plus the annual return, raised to the number of years. A small difference in annual return becomes a huge difference over decades. The 2.84% gap means the average investor ends up with far less wealth than the market itself. This line chart shows the growth of $10,000 over 30 years at 2 different returns. The blue line is the market return of 9.65%. The orange line is the average investor return of 6.81%. Notice how the gap widens over time. By year 30, the difference is enormous. This is the real cost of behavioral mistakes. So how do you actually implement long-term investing? First, set a target asset allocation and stick to it. Second, automate your contributions so you invest without thinking. Third, rebalance once a year to keep your risk level constant. Fourth, ignore the noise, don't check your portfolio daily. And finally, remember that time in the market beats timing the market. Sell everything. The market is crashing. Stay calm. This is normal volatility. But you're losing money every day. Long-term returns are on our side. What if it never recovers? History says it will. Stick to the plan. Long-term investing is the most reliable path to wealth, but it requires fighting your own instincts. The data is clear, the market works, but our behavior breaks it. By acknowledging your biases, simplifying your portfolio, and automating your decisions, you can close the performance gap. Remember, patience is not passive, it's an active choice to let compounding work. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.